Welcome back to another episode of Loanology. I'm your host, Jonathan Wells, and today we're going to talk about the importance of an emergency fund. Hello, and welcome to Loanology, your go-to podcast for unlocking the secrets of the mortgage and real estate world. I'm Jonathan Wells, and I'm here to guide you through everything from first-time homebuyer grants to the latest trends in real estate. Whether you're buying your first home, looking to refinance, or simply interested in the market, you're in the right place. Each week, we'll dive deep into topics that matter to you, the consumer. We'll demystify the mortgage process, explore innovative financial solutions, and provide you with the tools and knowledge you need to navigate the real estate market confidently. From interviews with industry experts to tips on improving your credit score and securing the best mortgage rates, Loanology is your ultimate resource for all things mortgage and real estate. So, whether you're here to learn a few tips, find your next home, or just curious about the market, tune in and let's make your real estate journey a successful one. So everyone talks about emergency funds, what they should be, where they should be saved, how much money you should have, etc. Right? Very simply, the reason why an emergency fund is important to myself, to you, anybody that's listening to this podcast, we've talked about a lot about investments, mortgage payments, everything that you can do where you're deploying your army of dollars to go make more money for you, right? And so all that a emergency fund is essentially an insurance policy in case something goes wrong. You can take care of that issue without having to draw from, the army that you have that's going out there and making you more money, right? Because that anytime you pull out of a retirement account or maybe take out a new mortgage or anything like that, if you're not prepared for it and it's not part of the plan, it could be a very costly, endeavor for you, right? Obviously, if you refinance a mortgage, there are a lot of benefits to that. But if you do it in a time that's unplanned and it wasn't a strategy, then it could cost you a lot of money, right? So let's talk about how much you should have. So the general rule of thumb is typically 3 to 6 months of living expenses to put into your emergency fund. So let's say that, it costs you between all of your bills and everything just to live, let's say it's $5,000 a month, right? You should have anywhere between $15,000 and $30,000 put aside so that in case something happens, you're able to pay all of your expenses again for 3 to 6 months, right? Now, you should also look into having things like short and long-term disability insurance and things of that nature. But also, having the cash put aside, like let's say, your AC goes out or your dryer goes out or whatever, you'll have the money set aside to take care of that item. One thing actually that I would like to mention, for me personally, and again, it's not financial advice, this is for entertainment purposes only, right? But if you let's say for me, let's say I got $30,000 set aside in my checking account or my savings account, and I need, let's say something goes out of the house, like the AC goes out, right? It's going to cost me $7,000 for me to fix it, right? What I would look into with the AC company is if they have any financing options available, right? Typically, any kind of home appliance or anything that's, any kind of cost that people would have, there's usually financing options for that. And depending on the term that you take out, there could be 0% financing options, right? So even though I have the money set aside for everything and I could pay that all in cash, if they're offering me 18 months of no interest, I'm probably going to take the 18 months of no interest because, the $7,000 that I would pay them today with inflation and everything else is probably going to be more money later on, right? So I can actually get, a reduced price for that today by, paying it out over the next 18 months, right? Again, you're not actually getting a discount physically from the product, but the money that I'm spending on that today, it's going to be worth less 18 months from now, right? So I'm able to make more interest off of it in my savings account and everything else. And if I'm, at 0%, I'm usually taking that option, right? So again, when you have emergencies, even if you have an emergency fund, you could still draw from that to make the payments on that and potentially help yourself out, right? But again, that's just me personally. Do whatever you want to do as long as you got the cash for it, and you can make that happen, right? So Also, the size of the emergency fund may vary depending on life circumstances. So I'm single, I live by myself. My emergency fund doesn't have to be as large as somebody that maybe has a family of 4 kids. Attention, financial planners. Jonathan Wells here with the John Wells Group, powered by Leader One Financial, and I'm here to collaborate with you. Whether your clients are purchasing a new home or refinancing for a debt consolidation in Indiana, Illinois, Michigan, Tennessee, or Florida, I'm providing expert mortgage solutions tailored to their financial strategies. Book a virtual meeting with me to explore how we can optimize their financial plans. Schedule now at the link below, and let's build stronger financial futures together. Right? There's a lot more variables that could, lead to potential costs when you have a larger family versus somebody who's single and lives by themselves, right? So, tips for beginning with a limited budget. So, I know we talked about in a prior episode how to invest and put money aside every month for your retirement. So, let's say your plan is to put aside $500 a month. Depending on how much you have in your in your emergency fund, maybe you're putting $250 towards your retirement and $250 towards your emergency fund, depending on what stage of life that you're in. I'm always of the mindset that I would rather have my money go towards retirement than anything else because I'm going to make a lot more, in the in the investments that I have there. However, you do need to have some money set aside for emergencies. So if you get a bonus, if you get any kind of a large you know windfall, financially, putting some of that aside into the emergency fund is really going to help you with that. And again, I would say minimum anywhere from $1,000 to $5,000, maximum probably about 6 months. Anywhere between 30 and 50 grand, depending on how much your expenses are and what your goals are too. Right? Most people have an emergency fund of somewhere between $1,000 and 10 grand. If you actually have an emergency fund, it's usually between those two numbers. So. Um, Also, where to save it, right? So a lot of times people talk to me and they're like, okay, cool. I bank with, let's say, I bank with a big five, bank, and I get, 0.001% interest on my savings, right? What I would tell you is if you're getting less than like, you know, 1% or whatever, right? You really need to look into other savings account options. If you just Google high yield savings accounts or high interest savings accounts, it'll come up with, probably 5 to 10 different accounts you can go through. Personally, I've used Marcus for a long time. It's by Goldman Sachs, or even M1 Finance. Those are just some companies that I've worked with personally in the past for emergency funds. And the reason why I've done that is they're online only, and they give a much higher rate of return because their expenses are lower, right? They don't have physical branches, they don't have things like that. So it is a little bit more difficult to pull money from those accounts, which is also nice too, because that way I don't spend it. um, but it pays you a lot higher of an interest rate, which you're not making money off of this. It's not your retirement account, but it is nice to make more than what a big five bank would offer you for a couple, maybe like under 1% in interest, right? Another thing too you could look at is credit unions. They typically have higher rates for savings accounts and things of that nature. What you don't want to do is put money into things like CDs or really any kind of an account that you have to lock it up for a certain period of time. Because the whole reason of this, the whole purpose of this account is to be able to pull from it when you need it. And a lot of those other products that you might be able to find at the bank or the credit union, they have penalties for withdrawing it early, which is doesn't make sense for you to do because you already have your retirement accounts for that, right? So definitely look into that. And then I've got a lot of clients that I've talked to over the past where they say, cool, I'm going to put, maybe they're allotting 20% of their overall gross monthly income towards savings. Maybe they put 15% in retirement and they put 5% into their emergency fund until that emergency fund's built up, and then they go full on into the rest of the retirement plan, right? It's really like you're kind of caught in that middle of, if you are young, you want to put as much money into retirement as possible because it grows the largest when you put it in as soon as you can. But you also want to protect yourself with an emergency fund too. So balancing that out, and it's a little bit more difficult than probably what meets the eye. But as you're growing this, and as you're younger too, your possibility for needing an emergency fund is less. So, having a little bit less in there is fine as you grow it, right? So, how to maintain your fund without dipping into it unnecessarily? For me personally, I like having it outside of my personal bank account because then that way, I got my all my stuff set up with, one of the big five, and then I have this separate savings account that I don't really see every day, right? It's one of those things where it's out of sight, out of mind. You don't really, I mean, obviously you review it as often as you can, but you're not looking at it every single day. So if I'm, going to go out drinking with my friends or whatever, I'm thinking, okay, I've only got $500 in my checking account. That's all, obviously I'm not spending $500 when I go out drinking, but I've only got $500 in there. I need to make this last for X amount of time. So I feel like I only have $500 that I can spend total, right? For the rest of maybe that month or whatever it is. When in reality, I've got more in in my emergency fund, but that's not mentally like using that money, right? I'm not thinking about that cash because again, it's not for this, it's for real emergencies. So best practice of maintaining it out of sight, out of mind. Have maybe when you deposit your check, 10% of that goes right to that emergency fund, whatever it is that you kind of have set up. I think is going to be privy to whatever your situation is, like whatever you think is best, go with that, right? So again, if you're under the age of 25, you're fine with like a couple $1,000s, right? If you are now you have a house, now you have bills, now you have responsibilities, but you're still single, then you want to have probably closer to about $10,000. And then once you start having kids, maybe getting married or having a partner or whatever it is, then that's when you really would want to push most likely into the $25,000 range or more. And again, if you can do more than that right now, that's perfect. Keep crushing it. But if you're just looking to get started, these are definitely achievable goals that you can strive for. Well, that's all I've got for you today. Please shoot me an email, johnwells at leader1.com or jonathanwellsprivate@gmail.com. Either way, I'll get back to you. Please keep sending the questions in. I'm more than happy to do everything that I can to make sure you're well prepared and well educated for any financial journey ahead that you may have. So thank you so much, and I'll talk to you in the next episode. Bye.